A $1.2 million SBA approval sounds like one decision. It is not. On a deal this size, the lender is evaluating several different risks at the same time. Can the business support the debt? Is the real estate worth what the borrower thinks it is? How much equity is actually in the transaction? Are affiliated businesses helping or hurting the file? And what conditions will the borrower have to maintain after closing? Today, I want to break down an anonymized $1.2 million SBA 504 approval and show you how an underwriter actually thinks through a large commercial real estate transaction. Let's start with DSCR. Debt service coverage ratio answers one basic question. Does the business generate enough cash flow to make the required debt payments? The lender does not simply look at revenue. A company can generate millions in sales and still have weak debt coverage if margins are thin or existing obligations are too high. Underwriting starts with the income available to service debt, then compares that against the annual payments created by the proposed financing and other obligations that must remain. That is why the requested loan amount and the amount the business can actually support are not always the same. But the first calculation is rarely the end of the story. Next come addbacks. The tax return may show expenses that reduce taxable income but do not necessarily represent recurring economic expenses going forward. Depending on the file, legitimate adjustments might include depreciation, amortization, certain interest expense, or documented one-time costs. The key word is documented. You cannot simply circle an expense and call it an add-back. The lender needs to understand why it should not continue and whether adjusting for it accurately reflects future cash flow. On a large transaction, those adjustments can materially change DSCR. That is why a detailed cash flow analysis matters. Now we move to the real estate appraisal. With SBA 504 financing, the property is a major part of the credit decision. The lender needs independent support for the value. If the purchase price or assumed property value is higher than what the appraisal supports, the financing structure may have to change. The borrower may need additional equity. The loan amount may need to come down, or the transaction may no longer work as originally proposed. This is one reason an approval before appraisal should never be treated as the final word. The property still has to support the structure. That leads directly into loan to value. LTV measures the amount of debt relative to the value of the collateral. The lender wants to know how much cushion exists between the property value and the debt secured against it. A stronger valuation can improve that cushion. A lower appraisal can reduce it. But LTV is only one part of the analysis. A property can have strong collateral coverage while the operating business still lacks enough cash flow. And a profitable company can still face a problem if the collateral structure does not meet program or lender requirements. Large deals usually have to work from both directions, cash flow and collateral. Now let's talk about something multi-business owners often miss: global cash flow. If the guarantors own other companies or have significant outside obligations, the lender may not evaluate this business in isolation. They can look across affiliated entities and personal obligations to understand the entire financial picture. Maybe one related company produces strong income. That could help, but maybe another company is losing money or carrying significant debt. That can weaken the global picture. This is why having multiple businesses does not automatically make someone a stronger borrower. The lender wants to know whether cash generated anywhere in the ownership group is being consumed somewhere else. On a $1.2 million transaction, that broader view can matter significantly. Next are liquidity and reserves. Closing the loan is not the only concern. The lender also wants to know what the borrower looks like the day after closing. Did the transaction drain every available dollar? Is there enough cash remaining for payroll, repairs, taxes, operating expenses, and unexpected problems? A borrower can technically have enough money to complete the transaction and still create concern if there is nothing left afterward. That is why using every dollar of liquidity for a larger down payment is not automatically the strongest strategy. The lender is evaluating resilience, not just closing ability. Then we get to covenants. This is the part many borrowers overlook because they're focused on getting approved. A covenant is an obligation the borrower may need to maintain after the loan closes. Depending on the lender and structure, that can involve financial reporting, insurance, tax compliance, additional borrowing restrictions, minimum financial performance, or limitations on major changes to the business. The exact requirements depend on the transaction. The important point is that approval does not mean the lender stops monitoring risk. When you review a loan offer, do not only ask, what is the rate? What is the payment? Ask what you are agreeing to maintain after closing. Now put all of these pieces together. The lender is not asking whether the borrower has one impressive number. They are asking whether the entire transaction makes sense? Does adjusted cash flow support the debt? Are the addbacks legitimate? Does the appraisal support the property value? Is leverage within an acceptable structure? Does global cash flow remain strong after considering affiliated entities? Does the borrower have enough liquidity after closing? And are the ongoing conditions manageable? That is the real underwriting story behind a large SBA transaction. One weak area does not always destroy a deal, but it usually needs to be understood and addressed. A lower appraisal might require more equity. A borderline DSCR calculation might improve after legitimate addbacks are documented. A weak affiliated company might require a deeper global cash flow explanation. An unusual expense might need supporting documentation. This is why large loan packaging is not about making the numbers look better. It is about making sure the lender sees the complete financial picture and can verify every important part of it. Before applying for a large SBA or commercial real estate loan, know these numbers and documents before the lender asks. Know your DSCR. Identify legitimate addbacks. Understand the expected property value. Know how much equity and liquidity you will have after closing. Review every affiliated entity and understand the covenants attached to the financing. A $1.2 million approval is not won by one number. It happens when the cash flow, collateral, borrower strength, and transaction structure all tell a story the lender can support. That is how you should prepare your file before it reaches underwriting. Learn the course for free at businesseligibility.com.